We woke to news that the United States and North Korea could not come together on a nuclear agreement. We also heard news that the GDP numbers in the United States were much stronger than anticipated. Now, whether that's good or bad depends upon the market sentiment at that time. Remember, normally you would expect good GDP numbers to be cheered on by Wall Street, but it also means that the threat of higher interest rates at some point down the road could be a little closer as a result. So what we did have at the end of the day was downward price action. However, it wasn't dramatic. This is the third straight down day for the S&P 500, but in total, the market has not been down more than 1%. So remember, there were plenty of days late last year where we'd move more than 1% up or down on a per day basis. And so generally speaking, the trends remain intact. We continue to have bullish postures across the board. In fact, we've got a bullish intermediate confirmation signal on the Dow and the Russell 2000 as of tonight as well. We're going to take a look at a stock that has been really bucking the trend, continues to go up at a very rapid pace. We're going to take a look at it from a trend trading perspective in our trade application example tonight. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 28th, 2019. First of all, if you're new, welcome aboard. Remember, go to our YouTube channel and click subscribe while you're over there. And then also go into our description area where you can sign up for our email distribution list, where you can be notified whenever we post these videos, and also will be notified whenever we get those stocks with overbought and oversold cluster signals, including that trade idea that I mentioned last night with Coca-Cola. Remember, that's where I got that insight, was by looking at that list. So anyway, take full advantage of that. We're also heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me, and make sure you click like and retweet if you get benefit out of these daily free videos. Remember, we generally will pin the post for our Market Outlook video to the top of our timeline to make it nice and easy for you to find. We also have links to it on our YouTube channel and also on our blog post itself. And then lastly, we do have a presence on Facebook as well. We would encourage you to join us there at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up in front of us. This is our traditional foregrid of the four major equity indices in the United States. As mentioned during the intro, the S&P 500 was down today, but it was only down 0.28%. You will see that that is the third day in a row to the downside, and the same thing can be said for the Dow Jones as well. But in the end, it's been very flat price action. So while the end result was negative, you can probably look at those charts and say, yeah, the trend is not in jeopardy at this point. Now, obviously, each day presents new and different information for us to digest, but at this moment in time, it doesn't appear that this bull run is over, at least from a technical analysis perspective. We remain bullish across the board from an intermediate term perspective. We can tell that very easily on this chart setup because the background color behind the current candle of all four of our charts continues to be green. And remember, you can also track that down below with the green line on the market forecast if you don't have the Think script that would go into painting your chart backgrounds the way that we have set up here for our premium scholars. So that's a good sign. The other thing I wanted to mention is that the Dow Jones and the Russell 2000 each had a trade setup according to the market forecast indicator as of tonight's close, and that trade setup is a bullish intermediate confirmation signal. You can see up here as an example on the Dow Jones, we have the green line in the upper reversal zone telling us that we have a bullish posture from an intermediate perspective, and then that's joined with the red line in the lower reversal zone. That's your momentum line, and so that completes that bullish intermediate confirmation signal. Now, a lot of times we do like to see that blue line in between 20 and 50. That is where we find ourselves. However, getting down there to 21 is almost a little bit too much. So, it's kind of the idea of Goldilocks and the Three Bears. You're trying to get it just right. And, in this particular case, while we do like that blue line between 20 and 50, this is so close to that 20 that it does make you think twice, perhaps a little bit about that. The same type of a setup occurs here down below on the Russell 2000. Again, bullish intermediate confirmation signal. Step one, identify the bullish posture using the green intermediate line, which is what we have up here in the upper reversal zone, and then that combined with the red line in the lower reversal zone. You can see there we're at 15.7, so remember any number below 20 is in the lower reversal zone, and here you can see yet again the blue line is between 50 and 20. It's even a little bit further away from 20, so in this case perhaps a little bit more interesting than the setup that is being presented on the Dow Jones. The other charts do not have bullish intermediate confirmation signals, but it was awfully close on the S&P 500. Notice we stopped the red line at 2440 when it was all said and done today, so not quite down below 20 to kind of trigger or activate that particular trade signal. Let's go ahead and take a look at our next chart setup. In this particular case, we're going to come on over here to chart 4C and look at the 3 green arrows setup. Mentioned yesterday during the presentation that none of our charts had 3 green arrows, and that continues to be the case. Now, the good news is none of them have 3 red arrows either. So we're kind of in no man's land right now, and that will often happen when stocks start trailing sideways. And remember, the 3 green arrows system that some of you might be familiar with from prior years with us is meant to be utilized on trend trading candidates. So when the market is somewhat trendless, like it has been for the last week or so, oftentimes you will start seeing kind of a mix of red and green arrows. So we kind of await further data when we're in a situation like this to see whether the market wants to break up or down. And of course, if the market breaks up, we're going to receive another set of 3 green arrows. If the market decides it wants to break down, that's when the 3 red arrows will start to come into play. But right now, we've got a mix across the board with all 4 of our equity indices here. Moving on now to the 1040 crossover. This is chart 4D. As I've been mentioning all week, the expectation at this point in time, despite 3 days of downside price action for the S&P 500, unless there's really some sort of monumental drop tomorrow, the expectation is that we should continue to have a bullish crossover as of and confirmed this week. Remember, we use weekly candles here, so this is a 10-period exponential moving average. This is a 40-period exponential moving average in the blue. So orange versus blue. Right now, the orange is up and above the blue moving average here on the S&P 500, and that's why that background color is green, to signify that we have this positive crossover that's taken place, which you can also identify with that black line when it crosses up and through the pink line on the chart. It might be a little bit easier for your eye to identify that. So right now we're in good shape. But again, I do want to stress that it is Thursday. Technically, we have one more day of the week before this is locked into stone. And so if we do have some sort of a massive downward move in the stock market tomorrow, then there is a slight chance that that will not be confirmed. But that is not my anticipation. I fully expect to come here tomorrow and see that we have indeed had an official bullish crossover on the 1040 crossover method. And of course, Dow Jones has already been there for a couple of weeks, and that would mean that the Russell 2000 would be our laggard in this case, because it does still have a little bit of work to do before we can have that bullish crossover there. Let's go ahead and take a look now at our 12 grid analysis, starting with chart 4E. This is our intermarket analysis 12 grid. And you will notice that the VIX was up today. Now, not substantially, so it was up 0.54%. Remember, that's pretty much a non-event when it comes to the VIX, because the VIX does move around with so much volatility. So the takeaway from the VIX is not that it was necessarily up today. That should be the expectation if the market was down. The bigger story is that the VIX remains near 3-month lows at this point, so there's very little fear in the marketplace right now. Now, one kind of identification that we had in last night's video that is following through today that's worth paying attention to is we continue to get more upside out of yields and more downside out of bonds. And that wasn't necessarily the case up until the last couple of days. So it is new information to us to kind of sink our teeth into. We don't know where it's going to take us quite yet, but what we do know factually is that the 10-year Treasury yield is now trading at about 2.71%, and it is now back up above that 30-day moving average that we see right there. And of course, the opposite effect takes place on the long bonds themselves. Remember, bonds and yields move inversely to one another. So no surprise to see TLT have another leg down here today, kind of following suit what we first started to identify yesterday. Notice now we have a price below a falling moving average. You can kind of see that moving average tip starting to change to red right here. So we want to keep our eye on that, because it does look like there's been kind of a substantial resistance area here on TLT, kind of going back to the beginning of the year. And remember, if the economy starts heating up And that's kind of what the stock market is telling us right now. Remember, they're not exactly 100% hitched to one another, but a lot of times you find that when the economy is very strong, the stock market responds in kind. Well, those are the conditions, like I mentioned in the intro with the GDP information coming in larger than expected. Those are the types of situations that the Federal Reserve is going to look at when determining whether they want to raise interest rates or not. And remember, they have control over the short end of the curve, but it's market forces that control the long end of the curve. And so that's why when you look at something like TLT, you will see much more movement, even if there hasn't been an official announcement from the Fed regarding interest rates. So keep our eye on that story right now. It is starting to look like bonds are starting to look a little bit more strained here in this environment. We find that the US dollar did have a little bit of pop here today. It is now above a rising moving average. However, its background color of the chart is pink, telling us that we do have a bearish posture, but it is at an area where you would expect some support. And so I'll be very curious to watch the US dollar in the days to come to see if we indeed get this support bounce that looks like has been setting up for the last couple of days. Gold has been another area, and that's that chart down here, kind of second on the bottom. These are your gold contracts that we're looking at here. But this one has been a little bit disappointing. You know, I really thought gold was about due for a bit of a breakout here about a week and a half ago, but it's really given back all of those gains. So we're sitting at a very important juncture here for gold. We're sitting right atop an uptrending 30-day moving average. So this is kind of do or die time for gold. You can see that it has held these levels for all of the last 3 months, meaning that it came down to the moving average here, rejected the possibility of slicing through the moving average, instead bounced higher. It did the same thing back here as well. And of course, it started that run 3 months ago right down there on the moving average itself. So you can see that in this particular case, the 30-day moving average seems to be important for gold futures contracts. And so where we ended here today at about $1,300 an ounce, $1,314 to be exact, is a critical level for those of you that are trend trading gold. So keep your eye on that. Another bit of a disappointment is down here with ag commodities. Now remember, when the US dollar is up like it was today, we should anticipate that most commodities are down, and that did definitely happen with ag commodities. If there was a disappointing element to it, it was that we thought perhaps yesterday there would be a start of a reversion to the mean type of a move, because we did receive that oversold cluster signal. So you can see today we did not add to that thesis. It took away from it, because we are now back down to even lower levels than on the day that we received the cluster signal. So, you know, where that brings us, we don't know. What I can say is that the last time we had this cluster signal would have been on this candle. You will notice that for the week or so after it, it did trade lower than on the candle where it received the cluster, and then eventually did pop. So maybe this will be a delayed reaction as well. Always hard to tell, but right now things look pretty ugly from a trending perspective when it comes to agricultural commodities. Crude oil bucked the trend today. It was a rare commodity that was actually higher. Notice crude oil was up 0.54%. Perhaps some of that geopolitical turmoil kind of added a little bit of a safety element, or not necessarily a safety element, but you will find when there's skirmishes around the world that oil prices tend to go higher, all else being equal, because a lot of times the places where there are skirmishes eventually are places where there is a lot of oil on this planet. And so if there is expected political strife, it's possible that some of the supply might be limited as a result. So anyway, crude oil had a very nice day, still trending higher, still has a bullish posture, still above a rising 30-day moving average. Let's take a look at our next chart now, and this one will be chart 4F. This is our foreign stock markets chart. And as you can see here, we do have some interesting developments here today. This is, in particular, Brazil, which is our first chart up in the upper left. It's been kind of going back and forth and back and forth. A couple days ago, it was bearish. Yesterday, it went back to bullish. Today, it went back to bearish. So what is different, and why I think today is maybe a little bit more important, is that we are now clearly trading below the moving average. So that was a piece of information we didn't have 2 days ago when it had a bearish posture that we do have now. So that's a little bit more concerning there. And in general, we had some uglier charts. You know, notice that Mexico, as example, was also down today, 1.2%. Not quite as much as Brazil's 2.6%, but nonetheless a pretty ugly day there. So, you know, perhaps Latin America having a little bit more of an outsized move to the downside right now. But if you look at that Mexico chart, it's kind of the same thing. I wouldn't be overly excited to be in the Mexico chart right now because it does kind of appear like we've got a little bit of a double top that's taken place, some fairly strong resistance up here ever since basically the middle of January, and now we have price clearly below that falling moving average. So there may be some bearish trade setups within securities in Mexico as a result. So anyway, we did have a little bit more downward price action in some of these foreign markets today. Part of that was just the fact that we already had some bearish action in the United States, but also remember when the US dollar is up, it generally has a negative impact on foreign investments. Let's go ahead and take a look here at our next chart setup, and this will be our US sectors 12 grid. And as you can see here, we only have one pink chart on the board today, which is good to see. Remember, yesterday we had both communications and energy. Now, this is a bit peculiar. I'm not sure what to make of this. I did notice a lot of the oil refining companies. So, as an example, MPC was down 2% today. That's Marathon Petroleum. We also had Valero down 1.8% today. Let's take a look at Phillips 66 down 1.3% today. So perhaps there was some outsized impact on XLE, which tracks all energy companies, as a result of some of the poor trading activity within the, specifically the independent refining companies within the energy space. But the reason I think of that as a bit peculiar is because you oftentimes don't see a day, unless the whole stock market is getting clobbered, which today I wouldn't really categorize as that, but you normally wouldn't see a day where energy is leading to the downside if oil prices are up. And that's why they play the game, right? This isn't normal, doesn't happen often, but it is happening nonetheless. So energy was down 1% today, and the only other worst performer out there was materials, which is 1.2% to the downside there today. So not sure what to make of that. I don't know if there was other industry-specific news. I was kind of out of the news flow today. Those of you that are premium market scholars know that I taught a 4-hour class today. Took full advantage of the fact that David didn't have his normal class today, so my time was allowed to run over, answering as many questions as I could from our students. So I was kind of out of sorts here in the middle of the day as I was in class and not paying attention to the market news. So perhaps there's something that I'm missing in the energy space that created a situation where the energy stocks were down 1% despite oil prices themselves going up. But that is not typical. So we'll keep our eye on it, see if it leads to anything dangerous. But right now what we know is it has a bearish posture according to the market forecast, because that intermediate line is at 77.98 and falling just barely below 80. But remember, if it were to pop back up above 80, this would revert back to a bullish posture. So we're not that far away from that. So I mean, we could wake up tomorrow and, you know, these energy stocks could be up 2% for all I know. And if that were to occur, then we'd probably flip right back on over to the bullish posture. But you know, we do have green charts across the board despite the one with energy there, and that's probably a promising sign. Notice utilities had a really nice day. Utilities were up 0.58%, and it's knocking on the door of 3-month highs there as well. So that was one of the leading areas within the market here today. All right, so with that out of the way, let's go ahead and talk about our trade application. What I'm going to do for this one is come on over here to chart 4A, and I want to talk about a stock that's been catching my eye, and it's not recent. I've been looking at it for a long time. In fact, I was very close to reviewing it for my top-down trend trading class that I teach on Mondays, but my hesitation, unfortunately, was that they were about to report earnings, and so I just decided it'd probably be better safe than sorry to hold off on the conversation until after earnings have come out to see how the market has digested things. Well, very interesting set of circumstances. The ticker symbol is Twilio. Might not be the most well-known company on planet Earth. It is a company that is a more recent IPO, so they do work in the technology field, helping customers send out text messages and other notifications and things like that to their customers. So anyway, it's an interesting situation in that the company did fall after earnings. So my initial hunch was, okay, well, thank goodness I didn't look at that in class because that thing really got clobbered after earnings here. But I noticed as soon as the day after that, so this was that day after the earnings right there, just got hammered. The very next day after that, it actually finished higher. I'm like, that seems a little bit odd. Usually the market really wants to flush these things down the toilet, especially these that have been up so much. Notice up here in the labels, Twilio is up 253% over the last year. This has been a massive, massive growth stock. And so it was a bit interesting to me that the market decided, hey, we'll just sell it off for one day here. And within a couple of days, I started looking at this price behavior. Now, again, I had thought about bringing it up during the market outlook video, but my hesitation at that point was, despite those really good-looking candles right there, we happen to be in what would be perceived as a bearish posture at that point because that green line did fall ever so quickly out of that upper reversal zone, giving us kind of a bearish posture according to the market forecast. Now remember, there are literally hundreds of technical indicators out there, and I'm sure there were plenty of others that were giving different signals, but nonetheless, it is what it is. So it was very interesting to me to see that within 4 days, this stock had regained all of its lost territory that it had after it reported that really ugly earnings with that ugly candle that occurred right after that. And as you can see here today, the stock was up dramatically yet again. We were up 1.87% on Twilio here today. And remember context, the stock market was down today. The S&P 500 was down 0.28% today. So if this would have occurred on a day when the market was up a bunch, yeah, no big deal. But the fact that it's happening day after day, consistently continuing to go higher, whether the market is in a favorable mood or a disagreeable mood, the stock seems to be desiring to go higher. And this is not a recent phenomenon. Notice that if I go back over here to a 1-year daily candle chart, this thing has just been a powerhouse winner over that time period. And while it did suffer during the fall and winter of last year, like the rest of the market, that is a period that is now being forgotten, right? That stock was down here in the 70 to 80 range, and we're all the way back up here to 120 again. And remember, the stock market itself, the S&P 500, is not at new all-time highs yet. It's not knocking on the door of it quite yet. So the fact that this thing hit new all-time highs basically right away here and continue to surge is rather impressive because it takes a different feel and a different shape than the vast majority of other companies that we might look at within the stock market. So what I thought we would do here today is recognize the trend and then implement a trend trade. And the idea in this case, I'm going to use a trailing stop here, so it'll be a little bit different than the way that I handle things in my Monday top-down trend trading class for my premium students, but nonetheless, the concept will hold true. As long as this stock stays in an uptrend, which right now appears to be the path of least resistance, then we will continue to try to benefit from that upside price action. If it does fall out of its uptrend, then of course we want our stop to be working on our behalf and get us tripped out of this, because if a stock has gone up 253% in a year, it has the possibility of going down significantly in value as well. So what I wanted to do in this particular instance, I'm going to get my drawing tools out here, and I'm just going to point on this trend line tool because I want to show you what the typical pullback is for this company from high to low. So let's go with this candle right here, and let me come down to the worst part of that move, which is right there. If I can get it right on there. It's right in that area. Notice that it's about 30% from high to low. I'm looking in that little box right there in the middle. It says minus 29.55%. So that was about a 30% drop from peak to trough during that ugly period right there. Now, if I look at some of these other ones, notice if I go right here from this peak to this trough, there, notice that the percentage decrease was about 28.08%. So again, right around that 30% drop in that vicinity. And then if I were to look at this most recent one, which is from basically the top of this candle right here down to the bottom of this candle when it kind of flushed out. Again, notice it was about a 27% move to the downside. So do understand this company is going to come with volatility. That is the nature of the beast. That's what it's shown us in the past, and that's what I would expect in the future as well. But it also looks like this company, generally speaking, doesn't go down more than, let's say, 30%. Maybe a little bit more, maybe a little bit less, but right in that vicinity. So I think it makes sense that if we're going to apply a trail stop to this situation, that we should have the trail stop be perhaps a little bit more than 30% in this particular case, which means that it will affect your position sizing. Remember, a lot of you would say, well, geez, I can't have a 30% trail stop. You can, it's just that you probably have to buy a lot fewer shares than you would have otherwise. And so remember that in order to cast a wider net with a wider stop loss, you're going to have to buy fewer shares because you're going to be taking on more risk there, but it allows you to absorb these little movements along the way. And had you used a 30% stop loss on Twilio over the last year, you still would have been saved by the bell and you would have made your 250% if you were lucky enough to be that person. So what we're going to do here is I'm just going to right click on the chart. And I'm going to go to buy custom. This time I'm going to go with stop, not the bracket order, but this time is just going to be with stop. And that loads up my trade down below. Now, of course, you're going to want to position size appropriately. This is a $120 stock, and so some of you might need to only buy a few shares in your paper money depending upon your account balance and different things like that. So I'll let you decide what's best for you, but there's no shame in doing a 10 stock or a 10 share order, right? Some of you might need to go higher than that to make sure it's an adequate size. In the end, we can't really account for that since all of you are such a diverse viewer base. But in this case, I'll just leave it in there as the default 100 shares for this particular paper money platform. And basically, I'm going to come in here and say I'm willing to buy this. Now, it does have a limit order in there at the top. Notice that it traded here today at 121.69. And so maybe I'll give myself 10 extra cents. So I'll put it in there as a limit order to buy it at 121.79 or better. That allows me for about 10 cents worth of flexibility there in the morning, just in case it opens up just a little bit higher. And then on the second line, this is where it says stop. I do want you to click on that drop down there, and instead of stop, look at the different choices that are available. There's everything from a market order to a market on close order and everything in between. Well, in this particular case, what I'm going to use for this trade example, this paper trade example, is to use this order that's called trail stop right there. And then over here to the right where it says day in the pink, I'm going to click on that and choose good till cancel. Then finally, on the bottom line here, notice that by default it says minus 10 cents in there, but there's this little kind of darker red widget that says plus and minus within it. I'm going to click that twice, 1, 2. Notice how it turned into a percentage there. And in this particular case, I'm going to type in the number of, let's call it 33. Okay, we'll have a 33% trail stop on this, so that way it has to prove to us that it's going to fall out of its trend and do something that it has not done over the last year, which is to fall more than 30% before we admit defeat on this one. So once I hit enter, notice that the system automatically changes that to a minus 33% on my behalf, which is what I want to see. All right, I'm going to click on confirm and send. And notice I'm spending about $12,000 here for 100 shares. There is our minus 33% when it comes to our trail stop, and everything else looks fine. So I'm going to go ahead and click send and ship that one off to the market to see if we get filled first thing in the morning. All right, well, I want to thank you for joining me yet again. I will be with you tomorrow as well because, of course, David is on vacation this week. But it's been a fun week for me to get together. It was nice to see some of these trades like United Health bearish trade continue to go down. And then yesterday with the Coca-Cola trade, that continued to go up today. So it's nice to see some of these trades working out. Have no idea with Twilio whether that's going to work out in the end or not, but without a doubt, it has been one of the strongest stocks in the entire stock market over the last year. So we'll see if that pendulum can continue to swing to the upside for traders in the coming weeks and months. With that, I want to wish you all the best with your trades and your investments. Goodbye for now.